Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know. First, WTO forecasts a 2.4% trade surge in 2025, followed by a 0.5% plunge in 2026, signaling a global trade whiplash. We'll explore how this front-loading to beat US tariffs creates a temporary boom that could trigger a sharp global manufacturing slowdown. Second, gold surges past $4,000 as Bridgewater's Ray Dalio urges a 15% allocation, challenging the traditional 60-40 stock bond portfolio. We'll analyse why the breakdown of the stock bond correlation is forcing this major strategy shift and what it signals for safe haven assets. Third, Carlyle data reveals just 17,000 jobs added as hiring plans plunged to 2009 lows, creating a recessionary signal amid a government data blackout. Today, we'll take a closer look at this conflict with surprisingly strong GDP data and its implications for the Federal Reserve's interest rate policy. The World Trade Organization just painted a picture of a global trade whiplash, and the numbers are staggering. The WTO is now forecasting 2025 trade growth to hit 2.4%, a massive hike from its previous estimate of just 0.9%. But don't pop the champagne just yet. For 2026, the organisation has slashed its growth forecast from 1.8% all the way down to a lackluster 0.5%. That's not a slowdown, it's a cliff edge. The reason for this boom and bust cycle is a story of strategy and consequence. The 2025 surge is being driven by what the WTO calls front-loading of imports as countries scramble to get goods into the US ahead of higher trade tariffs. So the thing is, this front-loading is a powerful but very temporary distortion. Think of it like pulling future demand into the present. The key here is what economists call a destocking cycle. After companies have rushed to build up their inventories to beat the tariffs, they will suddenly stop buying. This creates a vacuum, an air pocket in trade volumes for 2026, which could accelerate a global manufacturing slowdown. This is why that 0.5% forecast is so jarring. A key indicator to watch here will be the US inventory to sales ratio to see if warehouses are getting too full. However, if you zoom out, you'll see another layer of strategy at play. While tariffs are causing this distortion, a second powerful force is rewriting the rules of global commerce: artificial intelligence. In the first half of 2025, AI-related spending drove nearly half of all trade expansion, an explosive 20% year-over-year jump in value. This is a new global arms race, fought with silicon and servers. The core conflict is clear. Asia is dominating this new frontier, accounting for nearly 2/3 of the global growth in AI-related trade. And interestingly enough, this dominance goes much deeper than just final assembly. It's not just about the finished products. For a Chinese-speaking audience, this is particularly relevant. The key is control over the upstream supply chain. Take critical minerals like gallium and germanium, which are essential for high-performance semiconductors used in AI. China produces around 98% of the world's gallium. When China implemented export controls on these metals, it demonstrated a critical vulnerability in the West's tech ambitions. This shows that the so-called de-risking of supply chains is far from complete and highlights Asia's central strategic role in the future of technology. The US is fighting to keep pace, accounting for roughly 1/5. This creates a collision course. We're seeing tariffs acting as a powerful brake on the global economy, while at the same time, an AI-driven boom is providing a massive boost. These two forces aren't just cancelling each other out, they're creating a confusing picture. The massive surge in AI-related hardware may actually be masking underlying weakness from the tariffs. This is creating what some analysts call a two-speed global economy, where the tech sector is sprinting ahead while traditional industries are being dragged down. The bleak 2026 forecast reflects what happens when the AI hardware boom potentially hits its limits and can no longer hide the broader economic damage from protectionism. The entire system is balanced on a knife's edge. As the WTO Director General Ngozi Okonjo-Iweala stated, trade resilience in 2025 is thanks in no small part to the stability provided by the rules-based multilateral trading system. Yet complacency is not an option. So what should we watch for next? The key focal points will be the divergence between AI-driven trade and the rest of the economy. If the AI boom continues, tech stocks could remain strong, but this may not lift the entire market if other sectors are struggling under tariffs. Keep an eye on the prices of those critical raw materials, as they are a real-time indicator of supply chain tensions, and watch that US inventory to sales ratio. If it starts to climb, it could signal that the 2026 trade slowdown is arriving even sooner than expected. Speaking of an economy balanced on a knife's edge, it's no surprise that investors are scrambling for safety. And right now, all eyes are on gold, which just smashed an all-time record, surging past $4,000 an ounce. Now, one of the biggest names in finance is telling investors to rethink everything. Billionaire investor and Bridgewater Associates founder Ray Dalio is on the record, urging investors to allocate as much as 15% of their portfolios to gold. This is a direct challenge to decades of standard financial advice, which typically suggests only a low single-digit percentage for commodities. Now, get this. This isn't just about simple diversification anymore. The traditional 60 divided by 40 stock and bond portfolio is built on the idea that when stocks fall, bonds rise, acting as a safety net. But that relationship is breaking down. The key here is the stock-bond correlation. Recent data shows the correlation between stocks and bonds has turned positive, reaching its highest level in over 40 years. This means they are now more likely to fall together, leaving investors exposed. This breakdown is exactly why influential figures are now forced to look for a new safe haven, and they're pointing to gold. Dalio's reasoning is a stark warning. He compares today's economic environment directly to the early 1970s, a period rocked by inflation, massive government spending, and soaring debt that crushed confidence in paper money. The comparison to the 1970s isn't just talk. Here's where it gets interesting. The numbers are even more extreme today. For example, back in the 1970s, the US federal deficit peaked at around 4.5% of the entire economy's size, or GDP. By comparison, in 2020, that number skyrocketed to 12% of GDP. This shows that the scale of government borrowing and spending today dwarfs that of the 70s, putting immense pressure on the value of currency and debt. He asks, where do you put your money in? Dalio's answer is clear, not in debt. He claims that with such a massive supply of debt instruments, they are no longer an effective storehold of wealth. This isn't just one investor sounding the alarm. The call is getting louder. DoubleLine Capital CEO Jeffrey Gundlach recently went even further, suggesting a gold allocation as high as 25%. This seismic shift in thinking comes as gold futures have skyrocketed more than 50% this year alone, fueled by a flight to safety amid fiscal deficits and rising global tensions. Believe it or not, this rally isn't just being driven by everyday investors. A huge part of the story is what central banks are doing. The World Gold Council reports that central banks, particularly from non-Western nations, are buying gold at a historic pace. For instance, the People's Bank of China has been a major buyer, adding hundreds of tons to its reserves. This isn't speculation, it's a long-term strategic move to diversify away from the US dollar and hedge against geopolitical risk. This sustained buying from official institutions creates a strong structural floor for the gold price, making it less vulnerable to short-term market jitters. The traditional 60-40 stock and bond portfolio is now facing one of its biggest challenges from some of Wall Street's most influential voices. Dalio's argument boils down to one core belief. He stated, gold is the only asset that somebody can hold and you don't have to depend on somebody else to pay you money for. He's talking about something called counterparty risk. When you own a bond, even a government bond, you are depending on that government to pay you back. You are their creditor. Dalio is highlighting a growing distrust in the financial system itself, where the sheer volume of government debt is making some investors question its ultimate safety. This implies investors are not just hedging against inflation, but against the far more serious risk of government solvency. This is a profoundly bearish view on the stability of the entire system. So, what should we watch for next? Keep an eye on reports about central bank gold purchases, as this indicates whether the structural demand continues. Also, watch for data on the stock-bond correlation. If it remains positive, the pressure on the traditional 60 divided by 40 portfolio will only grow, likely driving more institutional funds toward alternatives like gold. This material is for informational purposes only and does not constitute investment advice. The value of investments can go down as well as up. We were just talking about a growing distrust in the financial system. Well, that theme continues as a government shutdown keeps the official September jobs report under lock and key, and investment giant Carlyle just revealed what Washington can't: a dismal jobs picture. A while back, we said trying to read the economy during a shutdown is like trying to read a map in a storm. The data gets messy. We also noted some strategists were treating shutdown fears as a sidebar and even buying dips, even as low-wage workers bear the brunt of the disruption in very real ways. Normally, the whole world waits for the US government's official jobs report from the Bureau of Labor Statistics, or BLS. It's the gold standard. But with the government shut down, the market is suddenly forced to rely on private data providers. This is where the situation takes a more complex turn. After all, these private reports like the one from ADP have always existed, but they often tell a different story from the official numbers. That's because they use different methods. For instance, ADP uses real anonymized payroll data from its clients, while the government's BLS uses a combination of business and household surveys. Historically, their numbers can diverge quite a bit, so when we only have the private data, it creates a lot of uncertainty. We've flagged this dynamic before, and when a shutdown creates a data blackout, those divergences get amplified. Carlyle's proprietary data, pulled from its portfolio of over 270 companies, shows the economy added just 17,000 jobs last month. That's a number so low, it's barely a rounding error, and even weaker than August's sluggish growth. And they aren't alone in this bleak assessment. Payroll processing firm ADP reported an outright loss of 32,000 jobs in the private sector. But what really brought this to a head was the next development. The most staggering figure comes from outplacement firm Challenger, Gray and Christmas, which reported that planned hiring by companies has cratered to its lowest level since 2009. Continuing our last discussion, where we pointed out that companies might freeze hiring without triggering big layoffs, this is exactly the kind of shadow labour shock we warned could be hard to spot in real time. When CEOs and CFOs stop planning to hire, it means they are worried about the future and are pulling back on investment in their most valuable asset, people. For this confidence to collapse to 2009 levels, even while current GDP is still growing, signals a deep-seated fear in the business community. It's a much stronger recessionary signal than 1 month of noisy payroll data. Remember, just a while back, we highlighted that initial jobless claims actually fell sharply down to around 218,000, suggesting firms weren't firing en masse. Today's twist is that hiring plans are the part that's breaking. The situation presents a fascinating duality. On one side, hiring appears to be slamming on the brakes, while on the other, parts of the economy look robust. The very same Carlyle analysis that flagged anemic job growth also pointed to surprisingly strong underlying GDP, running at a 2.7% annualized pace. Business investment also accelerated. We've seen a version of this movie before, not long ago. GDP for the prior quarter was revised up to roughly 3.8% with a surge in consumer spending. The open question we raised then still applies. Was that strength sustainable or just the last of pandemic era savings being spent? Actually, there's an economic explanation for this contradiction. It could be a sign of what's called labour hoarding. After the pandemic, many companies struggled immensely to find and rehire workers. Now, fearing that same difficulty in the future, they might be holding on to the employees they have, even if there isn't enough work. Instead of hiring more people, they are pushing their current workforce to be more productive. This allows economic output, or GDP, to grow, but without creating new jobs. As we discussed before, that also helps explain why layoffs and weekly claims can stay low, complicating the Fed's job. This could be the start of a jobless recovery, or it could be the quiet before a storm, if that business investment also starts to falter. This information battle is playing out in real time. While Carlyle sees just 17,000 jobs, Goldman Sachs is tracking a more optimistic gain of 80,000, adding another layer of intense uncertainty. With the official scorekeepers sidelined, the market is left to decipher these conflicting signals from the private sector. We previously analysed how shutdowns can delay key releases. Think back to the lags we saw in 2013, driving more volatility and forcing the Fed to be unusually cautious while it waits for clearer signals. That's the data war we warned about. And this isn't just a Wall Street problem. The US data blackout actually creates risks for the entire global economy. Central banks around the world, like the European Central Bank and the People's Bank of China, rely heavily on clear US economic data to guide their own monetary policies. When the US picture is this fragmented and confusing, it increases the risk of a policy mistake abroad. For instance, A misjudgment of the US economy's strength could lead to decisions that create volatility in exchange rates, including for the RMB, and ripple through global stock markets. And for a quick market barometer we've mentioned before, watch US. Sovereign CDS spreads, if they stay elevated, it signals persistent concern about fiscal stability on top of the data fog. So what should we be watching for? The key is to see if other data confirms this weakness. Weekly jobless claims, which are still being released, will be a critical focal point. A sustained rise in people filing for unemployment benefits would be strong evidence that the labour market is truly cracking. But as we noted earlier, the shadow shock means claims can stay deceptively low if firms keep hoarding labour. To cross-check, keep an eye on consumer credit delinquencies, which we flagged a while back as an early stress indicator, and yes, those US sovereign CDS spreads. If the shutdown drags and more releases get delayed, expect choppier markets and a Fed that stays extra cautious. If the slowdown is real, it could mean the Federal Reserve will pause its interest rate hikes. That would typically be good news for stocks and bonds, but it would also be a clear signal that the economic outlook is darkening. The bottom line is that while Wall Street titans disagree on the exact numbers, the trend from multiple sources points to a significant labour market slowdown. The most jarring fact remains, planned hiring by firms has hit a low not seen since the depths of the 2009 financial crisis, signalling a major economic shift may already be happening, hidden from official view even as the headline layoff data, for now, still looks calm.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.